Hello friends, welcome to my channel on Dynamics 365 F&O Solutions. This session is a continuation of my previous session. In my previous session, I had walked you through the accounting basics related to ERP and also showed you some scenarios where different account types are involved and how they are implemented in F&O. Today, I'm going to walk you through a sample use case for each use case. I'm going to show you what are the accounting entries impacted. And so let me open up the Excel sheet. So before I do that, please hold on for a sec. Okay. So this is my sample use case worksheet. So what I've done is I have created a few use cases. Against each use case, I have recorded the journal. Okay, so these are all the general ledger account and related, and then this is a debit column and it's a credit column, and there's a date of transaction. So now what I've done is the first use case. Let me walk you through the first use case: purchase of goods for $10,000. So purchase of goods for $10,000 means that goods are coming in and cash is going out. So this is a cash sale. So what is the related account? A purchase account is the expense account. There is no specific name mentioned here. It's a goods purchase of goods. So I'm just creating a purchase account, which is a generic expense account when I do some purchase. Okay, and then because I'm paying cash, I'm paying it through my cash account. So I'm creating a cash account. So now what are the debit credit entries? Now let's look at it. So something in this transaction, something is coming in, something is going out. What is going out? Cash is going out. Cash is now going out means that I have to reduce the cash. Remember the rule, no deal. When I have to increase, cash is an asset account. When I have to increase the cash, I have to debit it. But here I am decreasing the cash, so I have to credit it. Now the next is the purchase account. Purchase account is an expense account. Again, remember the term keyword deal. When I have to increase my expense, my expense is increasing because I'm purchasing goods. So my expense is increasing. So when I have to increase the expense, I have to debit. So that's the reason I have debited an expense account and I have credited a asset account. Okay. The next scenario. They sold goods to James for 4,000. Here, look at it. There is a customer name mentioned here. It's a customer James here. There's a specific name here. So I have to create a specific customer account called James account. Okay, but also I'm not receiving cash from James immediately. I'm doing a credit sales to James. I have an understanding with James. I give him some credit time. He's going to pay me after 30 days or 45 days, depending on my credit terms. So it's a credit sales. So there is no cash involved. If there is a cash involved, I would have used the same cash account. But because it's a credit sales, I have to create a account called the sales account. Okay, it's a sales account. What is sales account? It is a revenue account. Okay, the sales is a revenue account, and I have to record these transactions using a customer account and revenue account. So when I sell something, I earn something. So the earning is done through a sales account, which is otherwise categorized under the revenue account. So what is happening? I am earning something. What it means, I am now going to get cash later. But today my revenue is increasing. So what do you do if I have to increase my revenue? I have to credit it. Apply the keyword girls. S is the sales account in girls. GIRLS. S is sales account. I discussed in my previous video when I have to increase the revenue account or the sales account here, I have to credit it. So I'm giving a credit entry for 4,000. And then here, James account, he's a customer. It's my accounts receivable. Okay, my accounts receivable it's an asset account. Okay, I'll show you in my later sessions when I talk about the sales model. Here, James is my customer. I am receiving something because of selling goods to him, and it's an accounts receivable. I'm going to receive it later. I'm not now going to receive it immediately because it's a credit sale. I'm going to receive it in later stage, and so it's an accounts receivable. My accounts receivable is increasing. So accounts receivable is a asset account. So apply the keyword deal. A is for asset. So I am increasing my asset, which is my accounts receivable is an asset. So I do a debit for now 4,000. So that's the reason the these two accounts are created and the debit and credit are posted accordingly. Now look at this, the transaction is complete. Something goes in and something goes out. Both the sides of the transactions are getting recorded. Okay. Now I go to the next one, purchased furniture for 2,000 bucks. So here, if you look at it, it's slightly different. Here I'm giving a specific name for that account. Rather, in my first case, it was generic purchase of goods. So I used a purchase account. Whereas here, purchased furniture, I want to always record whatever expenditure I do against the furniture. So I create a new account called furniture account. Okay, but whenever I buy furniture, it's an expense. But I want to show how much did I pay for furniture, how much did I spend for stationery, things like that. So here I am creating a furniture account, and it is an expense account. So I debit using the keyword deal is expense. So when I want to increase my expense, I am debiting it. So I am also using the cash account same here, which I used my earlier scenario, and so I credit it. So cash is going out, I am crediting it. So this is a sample use case for on the related transactions and journal booking for this use case. Okay. Next is stationery. Just replace furniture with stationery, and then you get this journals. Okay. I move on to the next scenario. Sold goods for 100,000. Sold goods for 100,000 is the flip side of the previous transaction. What is the other side? When I sell goods, I get cash. Okay. So what is cash? It's an asset account. I'm increasing the cash asset account, so I debit 100,000. So to sales, what does sales here? Sales is a revenue account. So I'm selling goods for 100,000. Sales here is the revenue account. So when I want to increase the revenue, I have to credit it, apply girls, and so I credit sales account. That's why I get these two journal postings, debit and credit. Okay. The next is the sold goods to James for 4,000. Same scenario. Okay. Same scenario as above. So I'm not getting into the details. It's self-explanatory. Then the next use case, paid rent for 800. So what is the rent? It's an expense for me. So rent account, I open a new account called rent account. I debit because in expense, when I want to increase my expense, I'm debiting it. And what is going out, I pay cash. So money is going out, so I credit cash. And again, the next one is paid salary, 8,000. So I'm opening a new account called salary account. Salary account is an expense account. I have to increase the expense, so I debit it, and money is going out, cash is going out, so I credit cash. So these are all few simple use cases. Now I have created the journals for this manually. Now I have to ensure that my postings are correct. My postings are correct and it is complete and it is transparent. Now, how do you do that? I go and generate my trial balance. So the trial balance, as you recollect, it is nothing but a summary of all the unique accounts, and it will show the debit against each account as well as the credit against that account. Now, what I've done here is the trial balance. I have created a trial balance out of these above journal entries. I pulled out all the unique accounts, and that's why I get 8 accounts. Purchase account was pulled from this transaction, and James account and cash account furniture account, no, stationery account, and rent account, salary account. All of them are lined up here, and you get these unique accounts. Now, against each account, I sum up the debit and the credit. Now, in the purchase account, I have just mentioned it as 10,000. Where did I pull this? It is pulled from these transactions, 10,000. And there's no other purchase account here, so I'm just adding 10,000 here. And there is no credit for this account, so I'm leaving it blank. Then next is the cash account. What is the cash account now involved in my use cases above? So all the debit side, look at the about debit side. So this is a cash account debit. So I'm just pulling that figure from the above scenario. I'm then saying 100,000. So here it's a credit. What are the credits for the cash account in my above example? So I just have to see the cash account and look sum up all the credit for those cash account here, the cash account credit here, and the cash account credit here, and cash account credit here, cash account credit here. So if I sum up all the credits of the cash, I get 21,300. So this is the summary, and I booked both the debit and the credit for the cash account. Similarly, for stationery, I'm just pulling the 500 and the debit side, there's no credit side, so it's blank. And similarly, for all other accounts, I am pulling those summary information, and when I sum it up, I get the sum as 125,300 for debit and 125,300 for credit. So it means that this scenario is a correct scenario. It means that I posted all my transactions correctly, my journals are all correct, and when I create a trial balance, it is matching the debit and credit of all the accounts matches. Some of all the debits and credits for each of the for all the accounts matches. So this scenario is called in balance. If there is a difference, we call it out of balance trial balance. So if there is a mismatch, what do I do? I go to my individual account and then examine each account, and then if there is any wrong posting or double posting, and I have to correct that through an adjustment entries and then regenerate the trial balance. So this is a very, very simple scenario for explaining the use cases and the trial balance. Now that we know what is a trial balance, now let's go back to see how it is implemented in FnO. So I'm going to show you how the accountings are created in FnO. Okay, so please hold on for a sec while I bring my application screen. Okay, so okay, right. Okay, let me pull a purchase receipt. Journal that I showed you in my earlier session. So I go to purchase order. I showed you these purchase orders in my earlier session. Now I have this purchase order, and I have done a purchase receipt through receive product receipt. After I've done that, what happened was it posted the application, posted the product receipt, and it created a journal product receipt. I didn't create the journal manually. FnO did that. So FnO creates a journal automatically the moment I do product receipt and post. Okay. So this is where I have created. This is how the product receipt journal was created. Now let me go to the product receipt journal. Okay, so now let's look at the accounting entries for my product receipt. Okay, I go to the vouchers button to see my accounting information. These are of the general ledger account that got posted. And these are all the account names, and these are all the now debit and credit entries. Okay. Now let me start from the first entry. Okay. This is a purchase price variance, and the general ledger is the 310161. So why did this account get posted? Okay, because there is a two sides of a transaction. What are the two sides? One is that my goods are coming in. Here, goods are coming in. This is my inventory. So, and as goods are inventory, and it is an asset, and when I want to increase the asset, I have to debit it. So 180 means here a positive 180 means it is a debit, okay, entry, and the minus sign indicates it's a credit entry. FnO, in FnO, all the minus sign indicates that it's a credit entry. Okay. Now now let me go to the third line. This is a purchase expenditure uninvoiced. Okay. So what is this? So this is an expense. Okay. Now account, where did it pick from? Because I know I'm buying this, it is picked up from my purchase order line. Okay. Now let me show you where did this 175 come from. Okay. You look at this, this is the purchase line item, and 175 bucks got picked up from this unit price column. Okay. So that's the reason these three accounts got now posted. Now if you look at it, so because it is only 175, whereas this is picked up from, if you recollect my earlier session, I showed you that this is a standard cost. So it is picked from my item model standard cost price. The cost of the inventory is 180. However, I am selling it for 175. But there is a difference. Hey, your standard cost for the item which you are buying is 180. I'm going to book my cost of inventory is 180, but you are selling it for 175. There's a difference of $5. So how do I fill in the gap? So I fill in the gap of $5 by introducing a new account called purchase price variance. So this is how these three accounts got created. Okay. Now where did this account get pulled from? These three accounts got pulled from my item group setup. So if you recollect, I showed you the item groups creation during my product information management module setup. Okay. So these are the three accounts. I'll show you what are the three accounts that got picked up from. So this is the first one, purchase price variance 310161. Okay. 310161. The next is cost of units delivered inventory. What was that? It is the 120/100. Where did it get pulled from? This got pulled from this entry. So in my item groups, for each model I have configured in purchase order, I configured that 120/100 is my main account that needs to be used whenever I receive goods into inventory. Okay, that's why 120/100 got posted here. 120/100 got posted, and this is an expense account, and this was pulled from my purchase line. So where is this pulled from? Purchase expenditure uninvoiced 310110. That's why you see this 310110 uninvoiced. What does uninvoiced mean here? What does uninvoiced mean here? It means that I have received the goods from the vendor, but I am yet to pay him. It's on credit sales. When I create an invoice, then it becomes an invoice transaction, and this account will be rolled back, and you will see a new accounting added here. But now it is at a stage where it is uninvoiced. So that's the reason the purchase expenditure uninvoiced account got posted. Now when I generate an invoice, these will be given a reverse entry, and a new account will be introduced. You later into more detail when I actually walk you through the purchase transactions in detail. Okay. Now let's stop with this limited scenario, meaning specific to purchase receipt. Just wanted to show you what are the accounting entries and how to understand each accounting entry for each stage. Now we are at a product receipt stage, and these three accounts are impacted. Now it matches. Now the 175 plus 5 is the credit and 180 is the debit. So it matches. Now there is another dimension to this purchase order transaction. Okay, there is a vendor side, and there is a supplier involved here, and I owe money to my supplier. So there is a liability account getting introduced here. Because I am not paying cash, I am now getting a credit from my vendor. I have a liability to pay my vendor. So how do I record this liability? I record this under a account called vendor accrual account. But my liability is still not kicked off. When it will be kicked off when I create an invoice. So that's why it is a different account here, vendor accrual account. When I create an invoice, this will get rolled back and it will be added into a new account called accounts payable. Now because I'm yet to invoice, this is a stage, and at this stage, this is the account getting picked up. Where did it get picked up from? Let me go back to the item group and see vendor accrual account here. Okay, vendor accrual account, purchase accrual 210-0050, 210-050. I think this was account 210-050. Yeah, this is the account getting picked up. Okay. So, and because I'm giving a credit, again, minus 175 means it's a credit, it's a liability. Apply the terminology, keyword, deals, and L is liability. When I want to increase the liability, I have to credit it. So minus 175 means credit entry. And the offset account here is that I am spending money. It's an expense account. Okay, so my expense account is debited and my liability account is credited. So this is how FnO now creates entries, accounting entries, without we having to do it manually. As long as you create the item group set up correctly, automatically when you do a posting, these accounts get automatically created by FnO. Okay, I hope this example was simple, and you were able to understand this, and how to tie back to the accounting basics that I showed you in my previous session. Okay, so what we saw in the session is how the accounting entries are created and how to understand a sample accounting entry, how to decide which account has to be debited and which account has to be credited when you do it manually. But an FnO, how to do that? We have to do it by setting it up in my item groups for the purchase order transactions. Now, having said that, I stop this session here, and I look forward to my next session, where I will be walking you through purchase order creation from scratch, and also touch upon purchase product information management setups as applicable. Okay, so thank you so much for your time, and stay tuned to my channel. If you're interested, please subscribe to my channel. I'll see you soon, and thank you again. Bye.